Hey credit warriors, welcome to the show. And in this video, we're gonna be talking about how to build your credit score in the year 2021. If you're watching this in the future, don't switch off because probably most of this is still applicable as well. Also, first of all, I would like to say a big thank you to Cover for sponsoring this video. More on that later. So, if you want to build your credit score, you first need to know how to check your credit score. Now, the credit score that you can get from the two credit bureaus, Equifax and TransUnion, through the service Credit Karma, it's not a true FICO score that the banks use. It is a Vantage score, okay, which is more like an educational credit score. Now, as long as you know that, you can still use it. And if you're using it to check your credit for a credit card application, that's really not a big deal. It's still reasonably accurate. But for anything else like a mortgage or a car loan, it's not accurate at all. And if you are applying for a mortgage or a car loan, you are going to need that accuracy because the difference in just 1 point on your credit score on a mortgage or car loan application can mean a different interest rate. And a different interest rate could be the difference between paying thousands of dollars over the life of that loan, or it could make you not even qualify for the loan at all. So in this case, I recommend using myfico.com to check your credit score. Now, this is a paid service, so I wouldn't recommend this for everyone. There's really only any point using it if you're actually getting ready to apply for a mortgage or car loan. If you're just applying for credit cards, then you don't really need it. But I'm gonna be using the FICO system to demonstrate all this for you guys today, since that's actually what the banks are going to be using. So here are the 5 factors of credit that FICO uses to work out your score. I'll skim over them reasonably quickly because I know some of the people watching this will know this already. So we have payment history at 35% of how your score is worked out. We have amounts owed at 30%, length of credit history at 15%, credit mix at 10%, and new credit at 10%. Now these factors will start to make more sense as we go through the different FICO scores. And yes, FICO scores, not score, because you don't have just one credit score, you have different credit scores for different types of credit applications. It's a different algorithm. So let's check it out. All right, guys, so this is my Fico dashboard, and you are seeing Credit Shifu's actual credit scores here, which not many people get to see that. So first of all, you'll notice that My Fico gives you all 3 credit scores. We've got Equifax, we've got TransUnion, and we've got Experian, all right? Experian's the extra one you get on My Fico. On Credit Karma, you only get Equifax and TransUnion. And also you'll notice here, this is FICO score 8. Now that is sort of the standard generic score that lenders use. It's pretty similar to the Vantage score, although not exactly the same. So this is much closer to what the lenders would use. And if you see down here, you've got score versions by type, okay? Now mortgages and car loans, we'll come back to those in a minute, but if you click credit cards, you'll see that it gives you the 4 most common scores. Well, really this is the most common, the FICO Bank Card 8 score. So if they're not using FICO 8, they're using Bank Card 8, which is very, very similar, okay? 763, 781, 764. Some of these are a little bit different. It's like Bank Card score 5, 4, and 2. That's actually quite a bit lower, but it's only medium lender usage, okay? So the ones that most lenders are using now is Bank Card score 8. We've also got FICO Bank Card score 9, which is pretty similar to 8, which is getting more usage, okay? But most of them are Bank Card score 8. Then I'm gonna show you mortgages, okay? To show you my mortgage score, because there isn't just one credit score, all right? If a bank pulls a score for a mortgage, it's gonna be one of these scores. Okay, so let's check this out. Pretty different, right? Quite a bit lower. So you also get 3 scores. And what happens when they pull for a mortgage? Basically, when you pull a score for a credit card, normally it's just one credit union that's pulled. Okay, so Amex will pull this credit union, Chase will pull that credit union. It's not a hard pull on all 3, okay? Or some credit cards might do that. But when you do a mortgage, it's always what they call a tri-merge. So they pull credit score information from all 3 bureaus and they sort of merge that together. And how they merge it together is, if you have 3 scores that are all different, they pick the middle one. If you have 2 scores the same, they use those 2 scores that are the same. So if I was doing a credit score for a mortgage right now, I would be using, the bank would be using the middle one, 719, okay? Now currently I'm actually applying for a construction loan which requires a credit score of 720. So if they were actually pulling my credit now, I would actually not apply. I would not get approved for that loan because I have a credit score. The middle credit score is 719, and that's the one they'd use. I'm 1 point below. Now, this doesn't worry me at all because I know that I can increase my credit score very easily just by paying down a couple of balances, and I will be doing that in the next few days so that next time that particular lender pulls my credit, which isn't going to be that soon because I still have a load of documents that I have to hand over to them. But yeah, when they do go and pull my credit in like a month or so, it will be above 720. So I know to guarantee that, but it's great to have My Fico so that you can actually see that, okay? Now you may wonder why Equifax is a bit lower than the others, because I've looked through and actually the information in terms of like credit accounts and balances and stuff, it's pretty similar what's being reported on Equifax, but this is actually quite a common thing that Equifax scores tend to be a bit lower than TransUnion and Experian, especially for mortgage, just because of the way the algorithm works. All right, now let's go through the 5 factors of credit in detail using my credit report as an example. Payment history. So this is the most important factor, especially at the beginning. You need lots of on-time payments reporting to your credit report to build your credit score. So what you should do first is apply for very basic credit cards like the Capital One Platinum or the Discover It card. If you can't even get approved for those because your score is too low, or perhaps you're a new immigrant to the country and the credit bureaus really have no information on you whatsoever, you're like a shadow, you could get secured versions of those cards, okay? There's a Capital One Platinum secured MasterCard, there's a Discover It secured card. And the more of these cards you get, the better, because each card reports one on-time payment to the credit bureaus each month, as long as you're paying on time, all right? You have to pay on time. There are also other ways that you could consider to add extra payments, such as certain credit builder loan products, okay? Or services like Experian Boost that you can sign up for, and then they will report utility bill payments to the credit bureau Experian. There's even car insurance that reports a small revolving credit line and your payment of that line to the credit bureaus, and that service is Cover. It is car insurance aimed specifically at young drivers in their 20s and early 30s who have little experience and perhaps a reasonably low credit score. And credit score is actually a factor in determining car insurance rates. They spot applicants $250 to get their policy started. So that $250 reports as a revolving credit line to the credit bureaus, and you pay it within 30 days. There's no hard pull when you apply, and so this gets you another account and payment of that account on your credit report. Cover is a great option for young drivers and will generally get them the lowest rates available because, like we said, the policy is designed specifically for people with little driving experience and little credit history. If you're under 20 and on your parents' policy, you can even use Cover to lower your part of the bill. So I encourage you guys to check it out with my link below. Download the app and get up to 70% off of your car insurance. So in talking about payment history, you will see that mine is described as exceptional by Fico. And this is because I have never missed a payment on any credit product ever. And it's really important to never miss a payment because once you've missed a payment, it takes time for its downward drag on your credit score to wear off. The missed payment becomes less of an issue once it's more than 2 years old, okay? It affects your credit score less, but it only completely drops off your credit report after 7 years. When you miss a payment, it can knock up to 100 points off of your credit score, okay? That's if your score is high already. If your score is lower, it'll knock less off. But the key thing here is that missed payments only report to the credit bureaus if they're more than 30 days late, okay? So don't think that, oh, you missed a payment on your credit card, wow, you got a missed payment fee, that's a bummer, but hey, since I'm paying a fee anyway, I'll just string it out and I won't pay it for a few weeks. Well, don't do that, because as soon as it's 30 days late, it reports a missed payment to the credit bureaus and it tanks your credit score. Also, missed payments that are 60 days or 90 days late have a bigger detrimental effect on your credit score than one that is just 30 days late. So the moral of the story is never miss a payment, and I would even encourage you to set up auto pay for the minimum payments on all of your credit cards so you're 100% sure that you will never miss a payment. Amounts owed. Now this is 30% of how your score is worked out, and amounts owed is also called credit utilization. Now I am at about 11% of my credit limit across all my cards, which shows a balance of around $9,000. Now don't worry, I am paying it off every month. So I spend about $6,000 on credit cards and pay it off each month. Then in addition to that, I have about $3,000 balance carried on my Chase Freedom Flex card, and that is because I still have a 0% introductory APR. So I just spent on the card, and then I took the money I was going to use to pay it off and I invested it in crypto, okay? Now, I do not recommend you do this, all right? Because hey, the value of investment could go down. But for me, I'm making money on my investment, and when the 15 months is up, I'll simply take part of the profit that I made from that investment and use it to pay off the credit card, okay? But you have to know what you're doing. Don't go buying NFTs of fluffy bunnies and think that you can max out your credit doing that, okay? Because you could get into serious trouble, all right? So only do this if you know what you're doing. Now, even though my amounts owed is referred to as very good by Fico, it is still a different color green from the excellent I have on the payment history part. So it could improve. And because it's 30% of how your score is worked out, it really does have a big impact on your credit score, okay? So lowering this by even just a little bit could really help my score improve. In general, we recommend that you should keep under 30% utilization. But for me, I'm gonna set the target at being even under 10%, even lower down 9, 7% utilization, and this could really help my score improve. And all you have to do is just remember to pay off your credit cards early so they don't report those higher balances to the credit bureaus. In addition to that, lowering the number of credit cards you have reporting balances also helps to improve your FICO score. Even if you just pay off a card that had a balance of a couple of $100s, paying it down to zero so that the next time it reports, that's one more account that reports a zero balance, that helps your score. And if you pay a Chase credit card down to zero, it will even give you an extra report to the credit bureaus mid-cycle. So you will get some effect in improving your score from it immediately. All right. On to the next one, length of credit history. Now, if you look at my length of credit history on My Fico, it is orange, so they call that fair. Now, this is because I have opened quite a few accounts in the past year, the Chase Freedom Flex and the American Express Platinum card for Charles Schwab. This has shortened my average age of accounts, which is now just 3 years and 2 months. But if you click in, you'll see that my oldest account is actually over 6 years old. So what this tells you is that if you apply for a new credit card, in addition to the ding on your credit from the hard pull that you get, it will also shorten your average age of accounts. That's why you get some people who have like 2 credit cards from 10 years ago, and they really don't do anything with their credit. They just use them and pay them off every month, and they have a credit score of over 800. So it's kind of a paradox. The more you do with your credit, like applying for a new credit card so you can earn points so that you can travel the world for free, the more you harm your credit. But if you keep your credit score perfect, you miss out on all the opportunities to do that. So it is kind of a paradox. And my kind of suggestion would be that you need to strike a balance, okay? You need to strike a balance between the amount of new credit products you get and preserving your scores. So I would say only really apply for 1 or 2 new credit cards every year. And if you are going to apply for a mortgage or a car loan or something like that where you want a good interest rate, you need to ease up on any new credit applications. Basically stop any new credit applications 6 months before your application. And I would also recommend keeping your very oldest accounts open to lengthen that average age of accounts. All right, on to the next one, new credit. Now this factor is looking at 2 things, hard credit inquiries on your report. A hard credit inquiry is the type of inquiry a lender performs when they are making a lending decision. And then also the age of your most recently opened account. So mine shows 4 inquiries on Experian and 3 on the other 2. And my newest account is only 7 months old, the Charles Schwab Platinum card that I opened at the beginning of this year, and that gives me a fair rating. Now, hard credit inquiries drop off your credit report after 2 years, and your newest account will be getting older every month. So the more time that goes on, this will gradually start to sort itself out, as long as you don't keep adding lots of new hard inquiries and new accounts. And at the end of the day, this is only 10% of how your score is worked out. So for me, to improve my credit score quickly, it would be a lot more efficient to just focus on utilization and reducing the number of credit cards that are reporting balances. All right, on to the next one, credit mix. Now, credit mix is the factor that is looking at whether you have the complete range of credit products reporting to your credit report. Now, young people in their early 20s will probably just have credit cards, but as you get older, most people will start adding car loans and mortgages, and this serves to improve your credit score. Now, for me, I have the complete set. I have 7 credit cards, I have 1 mortgage, and I have 2 car loans, one of which is completely paid off. Now, while this helps to improve your credit score, it is only 10% of how your score is worked out. And seriously, you can't just go and buy a house with a mortgage just for the purpose of improving your credit score. You have to actually buy the house because you want it, okay? So this isn't something that you can really control. Only go and buy a house if you genuinely want to do it. Really, you can kind of forget about this factor in improving credit score. If you have it, it's good and it helps you, but don't sweat it if you don't. So I would say focus on payment history and utilization first. Then as the years go on, the length of credit history will start playing a bigger role in helping to give you a really robust and stable FICO score. But never forget about payment history and especially utilization, because that is the quickest way that you can improve your credit score. FICO 8 and FICO 9 are pretty sensitive to utilization, and just paying down that balance or reducing the number of cards that have balances can really have a big impact on your credit score. All right, guys, I hope you enjoyed the video. If you are a person looking for cheaper car insurance and a way to boost your credit score at the same time, do check out Cover. My link in the description. You can save around 70% on your car insurance. As always, thank you so much for watching. Please subscribe if you're new for new credit card tips and tricks almost every day. I'll see you next time. Bye-bye.